So today, Cathie Wood and ARK are mocked in some investing circles. Just 12 months ago, investors were piling into ARK and proclaiming Cathie Wood as the next Warren Buffett. However, in the last 12 months, ARK's main ETF has suffered a devastating 50% crash. And so it's no surprise that investors have been burned and turned against Cathie. Now, in this video, with the help of Cathie Wood, I want to provide a rational examination of what has gone wrong for ARK in the past 12 months. So over the past few years, I've been producing investing content, and I've often talked about how I'm a big fan of Cathie Wood. As someone who worked in crypto, I love anything tech related that could shape the future. Cathie's 5 platforms of innovation are exactly that: DNA sequencing, energy storage, robotics, artificial intelligence, and the blockchain. What could be more future looking than those 5 technologies? And with some bold early calls about Bitcoin and Tesla, Cathie made headlines as someone who could see future trends. Now, fast forward to 2020, and we were struck with something that nobody could foresee: a pandemic. With everyone forced to stay at home, Cathie and ARK stocks, which solved many of the problems of home working, they naturally performed extremely well. However, the flip side has been true as the world has opened back up again. As we've replaced Zoom calls with visits to the pub, ARK stocks have taken a huge hit. And as a consequence, they have been branded as stay-at-home stocks. To me though, this is not accurate. Sure, these stocks do benefit from staying at home, and the pandemic greatly accelerated this trend. But the long-term trend towards remote working is one which I see continuing to grow over the next 5 to 10 years. The recent tragic developments in Ukraine have shown the importance of something like Bitcoin, a key holding for ARK. And the opportunity for artificial intelligence, genomics, energy storage, and robotics has not changed over the past year. In fact, these technologies have continued developing over that time. Now, the problem is interest rates are on the rise. Sure, maybe not as much as was previously expected because of everything going on in the world, but they are on the way up. And this tends to reduce the value of companies, specifically companies which are the most forward-looking and have cash flows the furthest out, i.e., innovation stocks like those held by ARK. So what does all of this mean? Should we be selling ARK? Should we be holding it? Or should we be buying more, buying the proverbial dip? Now, I'm going to share my thoughts on this question very specifically in just a minute, but I want to first hand it over to Cathie to share her inputs first.
Today, the seeds for the innovation, the massive innovation that we see ahead, they were all planted in the 20 years that ended in the tech and telecom bubble. They've been gestating for these last 20 years, and now they're ready for prime time. Isn't it interesting that investors are scared to death? They're scared to death. Unlike the late 90s when it wasn't real, it's real today, and they're scared to death. And of course, macro forces, interest rates going up, the present value of future cash flows coming down. But a 50% drop in stocks based on with innovation, involved in innovation, is and has brought multiples down to levels. If you look at price to sales, below those for Apple and Microsoft and some of the most mature players. So we think innovation is selling at fire sale prices in the public equity markets. In the private markets, it's fascinating. It's been one up round after another as innovation stocks dropped 50% in the last year. The up rounds, there have been doubling and triplings of valuations in the private market. So major disconnect between the two markets. And, this is as wide as it was when I started ARK. And it was one of the reasons I started ARK, which was this huge arbitrage opportunity. One of these is right. And maybe they'll meet in the middle somewhere. But what happened the last go around 2020, basically it's the private markets that were much more right than the public
Have you learnt how to better manage risk and volatility, or is that not really important to deal with if you have the long-term view?
So volatility is not a bad word. In 2020, volatility on the upside was a beautiful thing, right? Because we've had such a difficult year, we get the volatility question. Our strategy is inherently volatile. Disruptive innovation is controversial. These companies are going to disrupt the old world order, which is the foundation for most traditional asset managers' investment management processes. These indexes are at the heart and soul. And I truly do believe they represent the most massive misallocation of capital in the history of mankind, especially because of the amount of innovation taking place and the importance of the US being at the vanguard, not to have public market support, having these stocks just pummeled and now companies thinking, I'm not going public, I'm just going to stick with the private markets. You're not going to be able to scale. Some will, but it is rare to be able to scale the way these companies will need to scale to capture these opportunities. It's the reason when Elon Musk threatened to go private, remember the famous tweet, funding secured, which got him into all that trouble. I wrote a public letter to his board of directors and to him saying, don't do it. You won't be able to scale the way we think you can scale. And, he says that was one factor the board considered after reading our letter. So we typically are going to be a small slice in terms of an equity allocation. And we have shown if you put 5 to 10% of our strategy, if you combine them with your plain vanilla growth indexes and value indexes, we do a couple of things. One, we provide a hedge against the disruption and disintermediation that will hit traditional benchmarks over time. And two, we increase returns and lower risk over a 5-year holding period because the correlation of our returns with other strategies is very low. Most of the names in our portfolios are not in the broad-based indices. The overlap is anywhere from 2 to 5%. And that's because Tesla now is 2.2% of the S&P 500. So very little overlap. So the correlations of our returns relative to other strategies, low. And from a diversification point of view, we're beginning to see more institutional interest because it's a good time to move into a category that has been pummeled, where the correlations are low. The person who should be managing risk is the asset allocator. We are not an asset allocator. However, we do behave a lot like a value manager. We are not momentum driven, despite what it may look like. We are not. We are taking profits all the time. Tesla was up 50% last year. We took profits all year to allocate towards the names that were getting crushed by fears of interest rates and inflation going up. So we do manage risk in that way. We're not momentum driven. I've seen a lot of people get into trouble as momentum players, but we are not going to be able to avoid, the pummeling of innovation in the public markets.
Okay, so the main point that I want to talk about is whether to buy, sell, or hold ARK. Now, what you have to remember is that the stock market isn't actually as bothered about what's happening today as you might expect. The stock market is based on what everyone expects in the future. So as an example, if I was to say to you, interest rates will go up by 0.5%, you could say that's obviously bad for the stock market. And you'd be absolutely right. Rising interest rates are, generally speaking, bad for stocks. However, the stock market might actually go up based on this news. Why? Well, if the stock market has been baking in expectations of a 1% rise, then just 0.5% is actually really good news. You see, even though bad news happened, if the bad news was less bad than expected, stocks will rise. So it all comes down to expectations at the end of the day. So the question for ARK isn't will interest rates rise, or will things continue to get worse around the world? What matters is, will things be better or worse than people expect them to be? This is the key point. It's all about expectations. And predicting this is virtually impossible. It's called the wisdom of the crowd, and it's very, very difficult to beat. That's why it's so hard to say if a stock is going to go up or down. It's also why I cannot sit here and say if ARK has bottomed or if it will fall further. Now, if someone tries to tell you they know this answer, just shut their video down, because they are either lying or severely overestimating their own abilities. Instead, what I'll tell you is there is a technique in investing which normally performs the best on average in the long term. And this involves diversifying using something called the Sharpe ratio. Now, I've explained the Sharpe ratio in other videos, so I won't go too deep here. But what you need to know is that you can improve your portfolio by looking for investments which offer you two things. Number one, low correlations to your existing investments. And number two, high average returns. Now, Cathie Wood's ARK fits perfectly into these two categories. Sure, their returns have been very poor over the past 12 months, but over the past 5 years, they've more than doubled the return of the American stock market, or the S&P 500. And in terms of correlations, as Cathie shared, only around 2 to 5% of their portfolio sits in the mainstream indices. That means when you buy ARK, you're buying companies that are so very different to the S&P 500. And this is how I personally see ARK fitting into a portfolio. I've said it many times, but I'll say it again. ARK is not a replacement for the S&P 500 in your portfolio. It's not a replacement for the UK equivalent, such as the FTSE 100. It's not a replacement for an emerging markets index. ARK is added to a portfolio alongside these investments because it improves the risk-adjusted return, or the Sharpe ratio, of that portfolio. Personally, this is exactly how I hold ARK, and a similar innovation investment in the UK called Scottish Mortgage Investment Trust. I hold them as part of a portfolio which also includes the passive stock market indexes, specifically the ones that I just mentioned. So when it comes to whether to buy or sell or hold ARK, for me the answer is simple. Nobody knows where the price is headed tomorrow. All we can do is make smart bets that work best on average over 10-year time horizons. Because ARK improves the risk-adjusted return of my portfolio, I will continue to hold them regardless whether interest rates rise further or there are more dips, or instead if they rebound because maybe interest rates don't rise as much as we expect. But those are just my thoughts, and I'm keen to hear yours. Are you buying, selling, or holding ARK? Let me know in the comments below. Thank you for watching, and I will see you again very soon.